The quiet signals suggesting a major shift in U.S. markets are not the kind that dominate headlines or trend on social media. They are subtle, often overlooked, and hidden in plain sight. But historically, these quiet signals have been the earliest warnings and opportunities for those paying attention. Right now, a combination of economic data, investor behavior, and institutional movement is painting a picture that something significant may be unfolding beneath the surface of the U.S. financial system. Let's start with one of the most overlooked indicators, market breadth. While major indices like the S&P 500 and NASDAQ have been showing resilience, the number of stocks actually participating in the rally has been shrinking. This means a handful of large companies are carrying the entire market higher, while the majority of stocks lag behind. This kind of narrow leadership has often appeared before major market corrections in the past. It's not necessarily a signal of an immediate crash, but it does suggest that the foundation of the market is becoming less stable. Another quiet signal comes from the bond market. Yields on U.S. Treasury bonds have been behaving in unusual ways, especially with the inversion of the yield curve. When short-term interest rates rise above long-term rates, it has historically been one of the most reliable indicators of an upcoming recession. While many investors are still focused on stock gains, the bond market is quietly flashing warning signs that economic growth may slow down sooner than expected. At the same time, insider activity is telling an interesting story. Corporate executives, those with the closest view of their company's financial health, have been selling more shares than they are buying. This doesn't always mean trouble, but when insiders consistently reduce their exposure during a market rally, it raises questions. It suggests that those with the most information may be preparing for a shift, even if the broader market sentiment remains optimistic. We also need to look at consumer behavior, which is a powerful driver of the U.S. economy. Credit card debt has been rising steadily, while savings rates have been declining. This indicates that consumers are increasingly relying on borrowed money to maintain their spending habits. While this can support economic growth in the short term, it often leads to financial strain in the long run. If consumers begin to pull back, it could have a ripple effect across multiple sectors of the economy. Another subtle but important signal is the shift in institutional money. Large funds and hedge funds are gradually reallocating their portfolios, moving away from high-growth tech stocks and into more defensive sectors like healthcare, utilities, and consumer staples. This kind of rotation doesn't happen overnight, and it rarely makes headlines, but it reflects a change in strategy from aggressive growth to capital preservation. And when big money starts playing defense, it's worth paying attention. Let's not ignore the role of the Federal Reserve. Interest rate policies have a massive influence on market behavior, and even small changes in tone from the Fed can trigger significant reactions. Recently, there has been a shift from aggressive rate hikes to a more cautious stance. While this might seem positive at first glance, it can also signal concern about economic stability. When central banks become cautious, it's often because they see risks that aren't yet visible to the public. At the same time, volatility levels in the market have remained surprisingly low. On the surface, this might suggest stability and confidence, but historically, periods of low volatility have often preceded sharp market moves. It's like the calm before the storm. When investors become too comfortable, risks tend to build up quietly in the background. Another factor to consider is global influence. The U.S. market doesn't operate in isolation. Economic slowdowns in major economies like China or Europe can have a direct impact on American companies. Supply chain disruptions, currency fluctuations, and geopolitical tensions all contribute to an environment of uncertainty. These global pressures are quietly shaping the direction of U.S. markets, even if they aren't always immediately visible. Now, here's the key point. None of these signals alone guarantee a market downturn or a major shift. But when multiple quiet indicators start aligning, it creates a pattern that investors cannot afford to ignore. The market doesn't move based on one factor. It moves based on the combination of many forces interacting at once. So, what does this mean for you as an investor or someone interested in financial markets? It means this is a time to be aware, not fearful. Major shifts in the market often create both risks and opportunities. Those who recognize the signals early can position themselves more effectively. whether that means diversifying investments, reducing risk exposure, or preparing to take advantage of potential market corrections. It's also a reminder that the loudest voices in the market aren't always the most accurate. Headlines tend to focus on short-term movements and sensational predictions, but the real story is often found in the quieter data, the trends that develop slowly over time and reveal themselves only to those who look closely. As we move forward, keep an eye on these subtle indicators. Watch how the market reacts to economic data, how institutions adjust their strategies, and how consumer behavior evolves. These are the signals that matter in the long run, because in the world of investing, it's not just about reacting to what's happening today, it's about understanding what might happen next. And right now, the quiet signals are suggesting that the next chapter in U.S. markets could be very different from what we've seen in recent years.